everybody. Here's Yulia Hazanov with Keller Williams Realty, and today I have a special guest, Todd Galde, and he's a lender and a mortgage advisor out here in Northern California with Cross Country Mortgage. And he's going to answer all the questions you had and have nobody to ask about real estate and the lending industry. So stay tuned because you don't want to miss that. Hi, Todd.
Julia, how are you?
I'm doing excellent. How
Awesome.
are you?
Thank you. I'm doing great. And thank you for giving me the opportunity. This is a great honor. Thank you so much.
Of course, yeah.
Awesome.
So, there are like so many questions that me and my clients want to ask you,
Yep.
especially with everything that's going on now in the real estate industry.
Right.
And one of the main topics that I wanted to ask you is how to get the right pre-approval and get our offer accepted.
Get the offer accepted,
You
yes.
know, it's like how to get it accepted finally.
Yes, that is a burning question, especially in California and in Northern California especially, because everybody wants to live here. And you're dealing with, multiple offers, right? 15, 20, 25 offers on properties. And the level of frustration can get high for people that have submitted multiple offers over several months. And a lot of the offers that agents that I work with on the listing side see are just not strong, right?
Mm-hmm.
And there are absolutely ways to increase and strengthen your offer. The very first way, quite frankly, is to get a full-fledged pre-underwritten approval, right?
Mm-hmm.
And so what that means is you're not just having a loan officer review income and assets and credit, but to actually have that submitted to an underwriting process and have an underwriter actually sign off on income and assets, right, and whatnot, and to have what we call a TBD, conditional approval, right? That solidifies your offer in a big way. That way from financially speaking, you're not going to run into any issues, right? Now, there are other ways that I like to utilize to increase the strength of the offers. I have actually 4 documents that I submit to every buyer's agent when they go to submit an offer. The first one is the pre-approval letter, obviously, and it's a customized pre-approval letter that is exactly the same number as your offer. So it's not a Joe and Mary Smith are pre-approved for a max of, right? It actually is identical to the offer that they're making. And what that does is 2 things. Number one, it doesn't let the seller think that, they're pre-approved for so much more, so we can counter them with a lot more, right? It's right at that same offer level, right? The second thing it does, it indicates to the seller and the listing agent that the loan officer, the lender, and the borrower are one. So they're working together on a daily basis, right? So the second thing I send is proof of funds, right? If you've ever submitted offer for a buyer, usually they just give you a copy of their bank statement, and then you cross out the account, and you include that with the offer. That's what most agents will do. I like to put a pre-approval, a cover letter, right, with my customized paragraph, talking about these are the funds that we vetted, right, and then actually a copy of the account sanitized, right, with the account numbers crossed out. But it's an official proof of funds document, right, from the lender instead of just the bank statement. The second thing is the underwritten conditional approval, right, and I use just the first page, right, to show the listing agent and the seller that, hey, this borrower is qualified, right? They've gone through the process. And then the fourth thing, now those 3 things, a lot of good loan officers actually will do, right? The fourth thing I've never seen done before, that is a letter. So I actually write a letter to the listing agent on behalf of the buyer. And so I basically say, let's say Joe is the listing agent. I say, hey, Joe, we recognize that your beautiful listing at 123 Main Street is going to get multiple offers, right? And you, Joe, have the hardest responsibility, right? Hardest job of all of us, which is getting the highest and the best offer that's going to close the fastest for your client, right? For your seller. And then the rest of the letter goes to strengthen the details of the borrower, how long they've been in their their employment, how they're a good, strong employee. They've been with their employer for a long time,
Mm-hmm.
and I go in a little bit more detail, right?
Mm-hmm.
And that letter I call it my strength of buyer letter,
Mm-hmm.
and that letter has truly actually gotten offers accepted over other
Mm-hmm.
offers, and so those 4 things I would recommend any loan officer to do for their clients
Mm-hmm.
in order to strengthen their offer.
Right.
Yeah.
And nowadays we need to be a little more creative with our offers, right? Because there are
Yes.
just so many like buyers out there, right? And we want to stand out and show how serious we are, right?
Right.
So
Right.
definitely gonna think outside the box.
Exactly.
Yeah.
And that actually, you bring up a good point with regards to being creative. Part of being creative from an agent standpoint is removing contingencies,
Mhm.
right? And we talked
Yes.
about it's kind of a separate topic in and of itself. And a lot of buyers have a tough time, and I don't actually advise removing contingencies,
Mhm.
unless it's 100%, vetted.
Yeah.
But we know there's 3 contingencies: the inspection, right, the appraisal, and the loan, right?
Mhm.
The inspection contingency, we as a lender don't care about, right?
Mhm.
You guys, if you decide to remove it, that's fine. We're not going to ask for the reports unless
Mhm.
they're mentioned on the contract anyways. And so whether you remove that contingency or not is
It's like up to the buyer if they
Exactly.
want to conduct any inspections
Yeah.
on the property or not.
Yeah, exactly. Now, the loan contingency obviously is a big one,
Mhm.
right? So my team, we, will vet a buyer, a client, a borrower, in such a way that we know that with 100% confidence this loan will close, right?
Mhm.
So I'm actually okay lifting a loan contingency as long as they've gone through that, that process,
Mhm.
and as long as they're not offering more than what they truly are qualified for, right?
Right.
Now, the one contingency that a lot of people have a tough time with is the appraisal, right?
Yes.
Because
And now it's just getting so tough because with the appraiser, I mean, buyers are just offering over the appraised value.
Mhm.
So besides offering over the asking amount, over the asking value of the house, then it's the appraiser value that they're like bidding over. And it's like, we're talking in like big numbers, like
Right.
$50,000, $100,000, even $300,000 over the appraised value right here in Danville and San Ramon.
yeah, exactly. And a lot of people will have concerns that if they're putting down 20%, for example,
Mhm.
on $1 million property, and the property and the offer or the appraisal doesn't come in at $1 million,
Mhm.
right? We'll use $1 million and then 200,000 and 800,000 to keep the math simple. So let's say the appraisal comes in less at like 950, right? A lot of agents think, okay, the buyer now has to come out of pocket with an extra 50,000, right? Do they have that money, right? And many times they don't, right? They're coming in with their 200,000 and
Mhm.
maybe 15,000 for closing costs, and that's all they have, right?
Yeah.
Well, you can actually structure the loan such that the loan to value, or LTV,
Mhm.
goes from 80% to 85, 86, 87%, right?
Mhm.
And there might be mortgage insurance, right, which is a monthly, we'll
Mhm.
talk about mortgage insurance
Yeah.
a little bit. So if you go above that 80% threshold, there might be a little bit of mortgage insurance that you have to pay, but you're not having to come out of pocket with $50,000.
Right.
And a lot of agents don't know that. A lot of borrowers don't know that,
Mhm.
right? That there's a way to structure it so that you don't even have to come out of pocket with extra money. So, so I always, say if when it comes to lifting the appraisal contingency, a lot of due diligence needs to go into whether or not you can go up to 85, 86, 87%, loan to value,
Mhm.
right? And whether we think the appraisal will actually come in, considerably less.
Yeah.
And I, whether you lift it or not is kind of a collective team,
Mhm.
conversation. But we do a lot of vetting, like a lot of great loan officers. We'll do our due diligence to see what the comparables in the area are looking like,
Mhm.
right? And if we think, maybe it could fall to 950, that's okay. We can still close.
Mhm.
Could it fall to 875?
Mhm.
Maybe, but I see comparables higher, so probably not,
Mhm.
right?
Yeah.
So, but it's
Okay.
that's a hard one to pin down because it's every transaction is different.
Yeah, and also with the current market, like because there are like we have so little inventory and there are so many buyers out there. Like I said, a lot of buyers are offering over the appraised value, so it's a matter of like, okay, what are you comfortable with, and can you really waive it? Which means that once you put your money in the escrow account, you know, your deposit, your down payment, then basically it's going to be really hard to get it back, you know. You know, you're going to need to go through arbitration or any other kind of not very pleasant process to retrieve your down payment back. So you need to be really certain you really want that house.
Exactly.
So.
The other comment, last comment I'll make on this is that we actually we can put an equity line behind a first mortgage to make up the difference if it does appraise for less. Okay. So you can do, if you've got an $800,000 loan and the appraisal comes in less and you don't want to come out of pocket with the extra, we can put a home equity line of credit in second position behind the first.
Okay.
Up to 90%.
Okay.
So that actually is another way to absorb that difference if it happens.
Okay. So here's the food for thought.
There you go.
All right. So what do you think about like the loans? So right now, a lot of first-time home buyers, they get approved for FHA, right? Yep. And FHA is very specific in this market because it's limiting and it's very low down payment, like 3.5%.
Right.
Whereas a lot of sellers prefer nowadays not to work with FHA loans, right?
Yeah, and I think so. There still is this negative stigma about FHA. And a lot of agents think that FHA is for low income, challenged borrowers, challenged buyers, and that's not the case necessarily, right? Now FHA does have looser guidelines, right? They will allow for a lower credit score. They only require 3.5% down, right? Our debt to income ratio, which is the all the mortgage payment and all the obligations divided into your income, that ratio can be relatively high with FHA versus conventional, which has a maximum threshold. And so there's this negative stigma about FHA, and I think it's been for years, right? That people have thought, well, FHA, we don't want to look at those offer because they may not be as strong, and that's not necessarily the case. So I think I would always consider an FHA offer. Now the one challenge I will say is if you are dealing with multiple offers, over asking, and there's an appraisal valuation issue, then that could come into play. Yeah. Because they're only putting 3.5% down. Yeah. Right.
So that's good. What would you say the main difference between an FHA loan and a conventional loan?
So let's see. So two of the big differences right out of the gate is the type of mortgage insurance. So conventional lending, which is Fannie Mae and Freddie Mac, we won't get into who that is necessarily, but it's basically those loans are sold on the secondary market, and they aren't government, right? They're not sponsored or insured by the government, which is what an FHA loan is. The mortgage insurance with conventional financing is a monthly cost, right? That can be very low, right? Depending on how good your credit is, how much money you're putting down. It can range from 0.1 up to 0.9, even 1, depending on your credit. But it can be very low, very minimal, and that's the only cost with mortgage insurance for conventional financing. Now FHA, I like to say the government has their hands in both pockets with FHA because you have the monthly mortgage insurance, which is 0.85. Okay, if you're putting 3.5% down. If you're putting more than 3.5% down, it can go down to 0.80. But that's the lowest it goes, is 0.80. Okay, now that's a monthly cost, just like conventional. There's also what we call an upfront mortgage insurance premium, okay, for FHA, and it's 1.75, okay, of the loan amount. So if you take a $500,000 loan, you've got an upfront mortgage insurance premium of almost $8,000. Okay, now that you don't have to pay that out of pocket. right? That can be added to the loan amount, but it's still a cost, right? So that's the biggest difference between conventional and FHA is the mortgage insurance costs are much different. I would say the other big difference is the fact that FHA is going to be a little looser, like I said, right? And conventional has a little bit more stricter.
To it.
Yeah, more strength, absolutely. Now, we talked about earlier, before we got on camera, about the fact that many borrowers get put into an FHA loan, right?
Yeah.
When they shouldn't be, right?
Yeah.
And so if I were, so as a buyer, if you have been advised an FHA loan, you want to ask why, right? Because if you've got good credit, and if you're, they're forcing you to put 3.5% down, conventional financing with a loan amount of 548, actually 548,000, actually allows 3% down, even less than FHA.
There you go.
Yeah. So as a borrower, as a buyer, ask your loan officer, why am I in this FHA loan, right? Because you could be in a conventional loan, and you know that a listing agent, a seller, will look at a conventional offer sooner than they will an FHA offer, right?
Yeah.
So, and on that note, actually, I do want to make this comment. For people that are watching that are buyers, that are looking to get into the market, and you've met with your loan officer, we're not geniuses by any stretch of the imagination. And if you've been doing this long enough, you should have enough knowledge, enough wisdom to be able to advise, accordingly. But you're the buyer. This is your mortgage, right? And so, don't feel intimidated by your lender, your loan officer, right? No. I really encourage people to ask questions, right? Why? Why is it this way? Why is it? And because this is your loan, right?
Yeah.
You shouldn't, you should feel confident. And people don't, right? They get, they get afraid, right? And
especially nowadays, like if you have any questions you don't understand about how your loan works, why did they came with the numbers that they came? So you can, do like a little video chat with the lender. If you can really meet them in person, like have a little session, have them explain it to you.
Yeah.
And a good lender should do it. So,
exactly.
right.
That's the key. Ask.